Well, up in Kenya, Standard Chartered Bank's rights issue kicks off today. The bank plans to raise 2.5 billion shillings from shareholders to buy the custody business of Barclays operations in Kenya. We're going to be chatting to Steve Ogada, Head of Portfolio Management at Dyer and Blair, in just a minute. First, though, here's what Richard Etemesi, the CEO from Standard Chartered Kenya, has to say about that rights issue.
I think so. I think the offer of 165 is a huge discount, and actually we see it as a recognition of a reward to our shareholders who've been very patient and very supportive over the years. And so, in arriving at the offer price of 165, we took that into account. And so, the attractiveness, especially compared to where the market price is today, and where it's been over the last 6 months, the 6-month average, I think offers a huge opportunity for a shareholder who has been patient up until now to take up their rights issue.
Well, Steve, thanks very much for joining us this afternoon. The rights issue, as we had the CEO saying, a reward to shareholders who have been patient with the company. It's priced at just over 165 shillings. That's a 39% discount on Standard Chartered's average price over the past 6 months. Is this attractive enough for investors to take up their rights?
Yes, it is attractive enough. I mean, that 5%, and for a bank that has consistently been performing well financially, I'm seeing a full subscription for the offer.
Well, how does the pricing compare to similar rights issues, such as Kenya Commercial Bank's recent rights issue, which I know was for a lot more money?
Well, the pricing, while high compared to other banks, but relative, is a huge discount. I mean, Standard Chartered is a stock that has consistently been attractive to investors, and it didn't suffer much discounting even with the market downturn. So you find, compared to say KCB that recently did a rights issue for which there wasn't much discounting in terms of share price for the rights issue price, I think the price is quite attractive.
Of course, KCB was aiming for 15 billion shillings. It's eventually got 12.4 billion shillings. So it was aiming quite a lot higher for money. So you think this one will be fully subscribed. When does it close?
Well, it closes in October. And what we are seeing is that investors will definitely be looking for the share, because you find that the allocation is about 5% in terms of, I mean, one right for every 18 shares held. So then the scale of investment is not much. So that's why we are foreseeing a full subscription.
Well, you mentioned recent profit growth. As Standard Chartered reported a 21% rise in first half pre-tax profits. Do you think this is giving investors the confidence to take up their rights in this company? As you said, one share for every 18 shares held.
Yes, it gives investors confidence. I mean, Standard Chartered has been very consistent in their model. It's a conservative bank. You find that Standard Chartered's model is one of leveraging on IT in order to achieve product distribution. So they haven't been involved heavily in CapEx for branch expansion. And also their target market is more leaning towards institutional, high corporate and high end of the market. So they haven't suffered much with regards to bad loan book.
And of course, it's using this money, or it plans to use this money, to buy Barclays custody services business. And this is just part of a wider deal that's going to see it buying similar businesses in a number of countries across the continent. Is this a good move for Standard Chartered in your view?
It is definitely a good move, because what Standard Chartered is doing is increasing its product offering to its customers and clients. And one of the synergies that they can leverage off is buying into an already existing business. I mean, they're not reinventing the wheel. They're buying into an already existing business, and they can leverage on the relationships already built. Aside from that, there's also increased liquidity because of the accounts that they'll be getting across.
Why does Barclays, though, want to let this business go?
Well, it's just part of their global strategy because they've exited custody business in various other markets. So the Africa segment was the one that was remaining, and it's a perfect fit for both the vendor and the buyer.
Just looking at appetite for banking stocks in Kenya at this point, of course, just ahead of that rights issue. I mean, what is the appetite for those shares?
Sorry, just say that again.
The appetite for banking stocks in the Kenyan markets at the moment, with Standard Chartered coming to the market with this rights issue. Are we seeing strong appetite for banks like Standard Chartered?
Sorry, say that again.
Are we seeing strong investment appetites for shares like Standard Chartered?
Yes, definitely. As I said earlier about Standard Chartered's model, they are not very aggressive, especially on the low end of the market, as other banks have been and have suffered, especially with regards to non-performing loans. So Standard Chartered's strategy is really working for them. Hence, it has maintained a superior return for investors and at the same time maintain consistent movement in terms of share price.
Steve, we have to leave it there. Thanks very much for your time this afternoon.